If you've just started out investing, you may be seriously confused as to where to start. So in this video, I'm going to give a step-by-step beginner's guide on how to start investing with Trading 212. So all you have to do to get started is to download an app just like Trading 212. However, there are plenty of other apps, and the thing that is most important when you're beginning is to get an app with low costs per transaction, because these fees will eventually add up and take over the amount of money you make in the long term. Now, it is important to understand that investing is not for the short term, it is for the long term. Short-term investing or trading is something completely different, and that involves a very high amount of risks, where essentially traders are looking to see volatility within the market, so prices going up and down, and try to time between that to make a profit. Usually for this kind of trading, you need a lot more money because you make very small fractional amounts on your trades. So this is not what we're going to be talking about in this video. So as you can see, I have my Trading 212 app open, and this is what it looks like when you log in. You're faced with a bunch of different stocks, and essentially what stocks are companies. So for example, Barclays, Lloyds Banking Group, BP. These are companies that are publicly traded, meaning that you can buy a stock from them. So when you buy a stock from them, you buy a very small amount of shares in that company. If that company then does better, it increases its profits, the amount that your share is going to be worth in the future is going to be hopefully a lot more than what it was when you bought it, meaning that you have capital appreciation. Capital appreciation is when you buy an asset. So in this case, stocks and shares are an asset. When it comes to selling this asset, the amount that you gain in profit is called capital appreciation. Same thing works with property. If you buy property for £100,000 and then you sell it for £120,000, that is £20,000 of capital appreciation. But you may be wondering, as a beginner investor, what on earth do you start investing in? And that is probably the biggest problem that you're going to face. And you also may be wondering how much you need to start investing. Well, these days you can start with as little as £1, and I'm going to show you this right now. So if I click on this arrow here, you can see the amount of free funds I have is £0. I'm going to deposit with you £1 so that we can actually start investing with as little as £1 and understand what kind of things there are, so what kind of assets there are that we can put our money in that will grow in the future. And if we consistently invest in this, if we consistently put in money whenever we get a free amount into these companies, into these investments, then in the long term that money will compound, it will gain interest, and we will have a lot more than we started with. So with Trading 212, in order to deposit funds, we press the deposit funds button and we will have a bank account linked with Trading 212. Now you can use your credit or debit card to actually top up your account. However, after the first £2,000 of deposits, you are charged with a 0.7% fee, which for me is way too much, and I would recommend that you actually link your bank account. So for me, I've linked my main bank account. I just press on instant bank transfer, and then I can change the amount I want to put in, which is £1. Now it will take me through my banking system, and I just have to approve this, and then I will have my Trading 212 account topped up with £1. So I received a notification saying £1 has been added to my account, and if I press here, we can see that I have £1 in free funds. This means I have £1 available to buy any stock or share that I want, and a platform like Trading 212 allows you to buy fractional shares, and we're going to get into that in a bit. So on the Trading 212 app, if you click the magnifying glass below, it takes you to a search bar where you can search the specific stock that you want to invest in. For example, if I wanted to invest in Tesla, I can just type in Tesla and it will give me all the options to invest in Tesla. However, taking recommendations from probably someone on YouTube is probably not the best idea, because the fact remains that nobody knows where the future of a company will go. Even the company director does not know. So that being said, under the magnifying glass menu, we have a list of stocks. So stocks, like we said, are shares of companies that are publicly traded. It is important to know that not all stocks will be a good investment. Some companies, and many companies do this, they will go bankrupt. So you may have heard this on the news, where a company's share prices has fallen and then the company went bankrupt, they went into administration. Essentially, if you buy shares in a company and it goes to administration, it becomes bankrupt, then all the shares become worthless, essentially no value, and you end up losing all your money. So in order to protect ourselves from losing all our money, what we want to do is to diversify, which means to put our money into different companies across different sectors. So sectors can be stuff like hospitality, so for example hotels and stuff like that. You can have energy sector, so like Shell, BP. You can have technology, so Tesla kind of falls under technology, but it also might fall under automobile. So Trading 212 allows you to see the most popular stocks, and I would never recommend to go into one of the most popular stocks and invest in it straight away. I've done this and I've lost thousands, close to £10,000, and the reason why is just because a stock is popular does not mean it will continue to keep rising. So let's actually go into a stock and see what Trading 212 gives us. So as you can see, this graph is very important if you are going to invest, because it shows you the movement of price of any given stock over a certain time interval. So for example, this one is maximum maximum. So it goes all the way back, in this case, to 2014, even though Amazon existed before 2014. Not all providers will have all the data necessary to make all your decisions. However, you can have the past year, so you can see the price has been going down gradually over the past year. And this is a lot to do with exogenous factors. So that just basically means factors outside the control over this company, such as the recession and such as the increasing interest rates. Over the past 3 months, you can see there's ups and downs. This is what happens to almost any stocks. There's always going to be periods of high values followed by periods of low value. And this is what it means to be in the stock market. It is not a safe investment. Something like a cash ISA might be a safe investment. Putting your money into savings account also will be a safe investment. However, investing in the stock market is never safe investment. This is why it's always important to invest in the long run, because as you can see over time period, the stock market generally tends to go up rather than down. So all these popular stocks are usually based in the USA. So Amazon, Apple, Tesla, Alphabet, Meta, these are all technology stocks and all American stocks. So make sure you remember that, because we're going to go back to that in a bit. As an investor, you may also have heard of dividend stocks. Essentially, a company pays dividends from its profits. So if a company made £10 million in profits and it wants to give all of that into dividends, it will give every single shareholder, as a proportion of the amount of shares they have, back dividends in terms of cash. So the more profits a company that pays dividend produces, the more the shareholder actually gets back. And this is an incentive for the shareholder to hold on to the shares because they're receiving a regular payment. These payments are usually either quarterly, so you get 4 times a year, or semi-annually, you get it twice a year. So not all companies pay dividends. However, there are some companies that do pay dividends, for example, AT&T. If we go into AT&T, the important thing to know is the dividend yield. So this number here is essentially the amount you're going to get in dividends as an annual basis, so as a yearly basis, based on its share price. So if the share price goes up, the dividend yield will also change as a result to that. So straight after dividends are paid, the share price usually does go down to reflect the change in dividend yield. So in addition to dividend investing, you may have heard of growth investing, and this is essentially companies, so the traditional companies that are investing a lot back into their companies and they see growth over time. That doesn't mean that they're not paying dividends, but they don't focus on paying dividends. The thing is, if a company keeps paying out all of its profits in dividends, it can't reinvest that back into the company, meaning that its growth overall might be a lot less than if the company was actually not paying dividends. So big companies like Amazon, Tesla, Netflix, Nvidia are considered growth companies. Technically, there's no such thing as a growth or dividend company, but as an investor, it might be important to know what these companies are focusing on in terms of growth or dividends. In addition to that, we have high volatility and low volatility. So volatility just means the price is changing at a rapid pace. Sometimes it goes up, sometimes it goes down, or there's been a huge decrease in its value, meaning it's trading at a much lower value, which could signal an uptick, and maybe you can get hundreds of percents back because of its low trading price. These are often referred to as penny stocks because they only cost a few pennies. Low volatility stocks are usually companies that have been established for a very long time and are needed in a functioning society, such as AT&T, which is the backbone to communications and a company that will probably survive a few more decades. We also have Coca-Cola, which has been around for decades, and as you can see, gradually the share price is overall increasing. However, if you do trade and if you don't invest for the long term, you could be buying high and you could essentially be selling low when the stock dips 40%. So it's very important as an investor to pick a company or a collection of companies and to consistently invest. When you consistently invest, say every month, you're buying low sometimes, you're buying high sometimes, then you're buying low again sometimes. So on average, when you buy lower and the price goes up, you're making money on that in the long term. So over the long term, buying consistently, which is called dollar cost averaging or pound cost averaging, essentially allows you to gain long-term wealth. So there's also a section called speculative stocks, and this is something that I don't recommend getting into because these are stocks that might go up, but they also might go bankrupt. So for example, Virgin Galactic is a company that has seen huge volatility because recently it has been announced that they haven't gone to the moon and they're losing a lot of money and they're probably going to go bankrupt. Some people like to buy stocks when they're very, very low with the hopes that it might shoot back up. But as a new investor and as someone who invests for the long term, it's probably not best to dabble in these companies because the risk is a lot higher than investing in companies that have been established for a longer term. So even after all that explanation, you still may be confused as to what to invest your money in. And the next tab I'm going to go to might actually just help you invest for the long term. So ETFs are very important and they're more and more becoming more popular because of social media and things like that. So ETF stands for exchange traded funds. And essentially, like I said before, if you want to reduce your risk in investing, you want to diversify your portfolio, meaning that you want to invest in different companies into different sectors. So if one company goes bankrupt, you're not going to lose all your money. And essentially, as a beginner, I would mostly recommend, even though this is not financial advice, to invest only in ETFs. So if we go into our most popular ETFs, this is probably the only time I would say that the most popular section in Trading 212 is something that you could actually get into without losing a whole bunch of money. So this is the most popular ETF that most investors that I speak to invest in, and this is the Vanguard S&P 500. You might have heard of Vanguard. Vanguard has been around for a few decades now, and it was the first to offer very low cost investing into a diverse class of assets. So essentially what the S&P 500 is a collection of the top 500 or so companies in the USA. So this is the Vanguard USA S&P 500. So just by buying this single fund, you have exposure to the top 500 companies in the USA, including companies like Alphabet, which is Google, including Tesla, including Microsoft. You're getting all the big ones, even Apple. And as a bonus, it still pays a dividend yield of around 1.3 to 1.7%. So this is exactly what I'm going to invest my £1 in. So all I have to do is press buy. So as you can see, one share of this ETF currently costs £62.69. However, I only put in £1 and I only can afford £1 today. That is not a problem because with Trading 212 you can invest with as little as £1. So all I need to do is go, instead of pressing number of shares, I'm going to go into value and then plop in just £1, and as you can see, it will give me around 0.015 shares. I press review order. So when you go into review order, you can see the details at a glance. So I'm going to get £1 worth of shares. The number of shares is going to be around 0.015, and the best thing about Trading 212 is that there is no commission on buying these trades. Many other platforms might charge commission, however Trading 212 does not charge commission, and the total is just going to cost £1. I'm going to press send buy order, and because the markets are open, you're going to see that I have bought 0.015953 shares in the Vanguard S&P 500. So as a beginner investor, all you really have to do to get lots of exposure to the stock market, so over 500 companies you're getting with one single fund, is to consistently invest. And as you can see, over the past few years, the S&P 500 has actually just been increasing, although there has been massive dips, first of all in the pandemic, and then now a very volatile scene here where it's going up and down and up and down, up and down. However, as a beginner investor, as someone who is investing for the long-term horizon, putting money in when it's high is not bad. Putting money in consistently, so every month when it's high, when it's low, allows you to ride out all the bumps in the stock market, and you'll see that within 10, 20, 30, 40 years, the amount you earn is just going to compound and compound, and that will lead to long-term wealth. So if I use this compound interest calculator, I can show you how much you could expect to be earning by consistently investing every month. So this is based on an annual return of around 8%, which the S&P 500 historically has done a bit more than that. But let's say we put in £1 today and we invest £10 monthly. If you're thinking about 40 years with only putting £10 a month, which I'm sure most of you can do, let's just see how much that brings us. So as you can see, if we actually just saved £10 a month for 40 years, putting in a bank account, we would have £4,800. However, if we had invested into the stock market, we would have around £34,000. So this is an interest of around £30,133 of basically just free money, which is over 6 times what you deposited, showing the true power of compound interest over a specific amount of time. And of course, you can use this calculator yourself. You can increase the deposit amounts yourself. So for example, £100 a month will actually lead you to having over £1,300,000, and that's an interest of £300,000. So make sure to check out some of my other videos, and I will see you in the next video.